Good afternoon. This is Kathy Neifeld, one of the four partners at Agency One. Together with Ed Lesher, Dennis Bartos, and Gonzalo Garcia, I am honored to welcome you to the 2020 Agency One Annual Advisor Conference. This is the final week of the Agency One Virtual Advisor Conference. We only have 2 days left, including this afternoon, filled with great speakers and content. We hope that you have registered and will attend the upcoming sessions. We have a lot of new advisors joining us for this session, and many are not familiar with Agency One. The principals of Agency One have been working together for more than 30 years, always in the life insurance brokerage space. We love what we do, and we love working with the advisors that are part of our Agency One 100 group. One of the tenets or basic value propositions that is central to our Agency One offering is providing educational content, networking opportunities, and idea sharing with our advisors. That is exactly what we have been doing over the past month during our virtual advisor conference. If this is your first time joining us during the meeting, welcome, and we look forward to getting to know you better. For those of you that we already know, thank you again for joining us today. Earlier today, we heard from Kim Lear with Inlay Insights, who spoke about understanding change in generational time and how, among other things, this impacts wealth and financial planning. If you missed that session or any of the sessions from the last 3 weeks, they have all been recorded and are available to you on the CVent site through the Attendee Hub. This afternoon, we are hosting a workshop on the RIA Advantage. The RIA Advantage is a unique product designed with the registered investment advisor in mind. It is a product designed to help clients shelter assets earmarked for retirement from the confiscation of taxes during the accumulation phase and create a tax-free income stream in what will likely be a rising tax environment. Before I turn this over to Fred Domenico, Head of Independent Distribution for Equitable, to introduce our next speaker, I want to thank Equitable for sponsoring this session, and I also have a few housekeeping items. Number one, all attendees will be on mute. Number two, please submit questions through either the chat function in the Attendee Hub or at the bottom of your screen. Three, the session will be recorded, and a link to the recording will be made available after the session. And finally, please do not forget to complete the session survey after the session. Again, I would like to thank you for all being here today, and I am going to turn this over to Fred. You will also see my partner, Gonzalo Garcia, who is going to be interacting with Fred and our speaker at various times during the session. Fred, the floor is yours.
Oh, Kathy, thank you so much. And thank you to everybody out there in our virtual world, and to my friends and what I consider to be extended family at Agency One. I say thank you. A tremendous partner of ours, somebody that when we thought about this offering, and it is a unique offering into the marketplace, literally one of the first partners we thought of was Agency One. And so I couldn't be happier to enter into this arrangement with my friends over there. And I hope that you find this session not only valuable, but a tremendous help to you in your practice moving into 2021. Just a few words before I turn it over to really the main performer today, Randy O'Brien. Equitable has been around since 1859. We've been doing this for a very, very long time. And throughout the course of our history, innovation has really been the forefront and the leader of our development and our success. And frankly, innovation today is making possible things once thought difficult or impossible. And I would tell you that today's session is exciting, not only for us to be joining Agency One in the delivering of this message, but also as we engage on this journey ourselves into what we believe is the fastest growing segment of the financial advisory market. Forces are converging to fundamentally transform financial advising. And to us, the RIA is poised to take the biggest and most advantage of that success. And so earlier this year, Equitable made a purchase of an organization out of Springfield, Illinois called Corporate Endowment Solutions. Randy and Barbara O'Brien founded Corporate Endowment Solutions, or CES, and they partnered with Equitable through the years to build what has been an extraordinarily successful business. I've gotten to know Randy really, really well over the last year and a half, and it's been a tremendous benefit to myself and my career. His insights, his enthusiasm about this side of the business, and frankly, just his creativity when it comes time to thinking about what the advisor views and sees in the marketplace and how to apply that beneficially to their practice. And so Randy O'Brien is the managing partner of Corporate Endowment Solutions. He is now part of the Equitable team. I am extraordinarily excited to have him as part of the team, and I will turn this now over to him to introduce to you something that we have designed at Equitable for the RIA space. So over to you, Randy.
Thank you, Fred. Thank you for all of you taking the time today to hear a bit about the RIA Advantage and the Equitable. And, the importance of RIAs at 22,000, I believe Gonzalo and I were talking about at last count, is adding their alpha to tax advantages, in particular 7702, while retaining AUM. It's probably been their biggest struggle. And I want to echo what Fred said about Agency One. Kathy and Gonzalo have been awesome to have known and awesome to work with. And at Equitable, this platform is one that is not going to be commoditized. We are selecting key partners to work with, of which we are thrilled that Agency One has raised their hand to be part of a select group. So thank you very much. Well, let's move forward into this space. First and foremost, we spent the last 2 years really just trying to fully understand the market. We had the pieces, but it's really understanding the market from the institutional product approach, but yet backing it up to look at processes of what companies are doing. And more importantly, how do you design a platform that could be an offering to the to answer the RIA fee-based dilemma. I think that these bullet points are what was overstated from multiple focus groups. The pure idea of their ability, the dilemma is their ability to retain AUM while recommending life insurance benefits of IR and that of IRC 7702. They also felt that the limited asset management with technology support was a major hurdle, and their ability to coordinate asset allocation. The lack of field implementation expertise, as you know, most RIAs, unless they've remained hybrid or work in a benefits firm, the implementation of insurance, especially for accumulation-driven plans, not so much for the wealth replacement, but for the tax code impacts, has been a challenge. And when you've given up your licenses, it makes it even more of a challenge. And then the service and contract administration. We've seen in the marketplace already that there have been agreements go forward in this space that for one reason or another, one of these 5 bullet points or multiple of these bullet points have found a dead end to some of those arrangements. And so as we move forward, the carriers still are somewhat still at a loss of what to do in the space. They're looking at expanding existing product to a fee-based world. Generally, the products are relatively complex from either transparency in pricing or transparency in getting to a illustrated dollar amount in out years. They don't really have anything that differentiates them from a performance. They lack an ability to aggregate those values, rolling up to a more holistic portfolio. The carriers also are fairly random at point of sale support, implementation expertise, and then the future service support, which again, one or all of these have been an issue. At Equitable, the next slide, we really want to more go into what we believe is a crafted solution that will provide an RIA with access to the institutional life contracts with individual or trust ownership. If you think about the space, an institutional product with no surrender charges that avails itself to the accumulation with high account values makes all the sense in the world. Our industry, however, has struggled over allowing that institutional product to be either individually owned or trust owned without a corporate sponsorship or corporate checks to settle those plans, which creates some fiduciary liabilities. We believe we've addressed that with the simple access that the CES platform has created over the decade plus years of working with Equitable. It's designed and managed to the tax codes just as we would CFOs for CFOs in larger corporations. It's meant to generate revenues through AUM fees that can be billable and transparent on cash value accounts. Of course, the daily valuations at the fingertips of the RIA for billing that is provided through the administrative portal, and then providing through Agency One the comprehensive support, including certified point of sale specialists that are growing within Agency One for contract implementation, for administration, all with RIA protection agreements that will, if not, will be required in this space. So let's look at the features of the RIA Advantage. First, it's the enhanced performance with reduced compensation that's reflective of the core sales commission that usually lies within an institutional product. However, blending that back in, increasing the potential maximization under 7702 makes it a key advantage. Let's look at just the marketplace here. Let's take we have an average male age 50, and we're going to utilize 7Pay because 7Pay is easiest to for the RIA to understand, for the clients, other advisors, tax and otherwise to understand, but very similar to how corporations buy it. But you can see in the COIL IS, that would be the traditional institutional product sale. You can see in column A, the 7Pay, but you can see how the cash values at key years, whether it's the first year, 5th year, 7th, 10th, and so on, grow at a 7% gross assumption rate. Under the RIA Advantage, you can see in columns D, E, and F, the increasing differences in a static 7% growth of the plan. And you can see, because of performance tied to the tax code, the actual death benefit by corridor being pushed up by the increase in performance, thus creating policy value differences that while the way institutional products work in credits back of expenses versus surrender charges, the impacts are seen in early years, 5th year, 7th year, 10th year, that can easily be an offset to either flat rate or can be an offset to basis point charges that the client, the RIA, may agree to. What we find interesting is the performance increase has an impact on the death benefits. We had in our focus groups RIAs didn't even consider the fact that if successfully managed as they believe it would, that the step up in basis should in the event of death occur, that whatever the fee structure is would be softened, if not totally offset, but not just the cash, but the improvement to heirs via the death benefit.
Randy, can I jump in here? I want to try to unpack this a little bit. So just
Sure.
kind of, I don't have any questions yet, but I just want to try to be additive to the conversation. So for example,
Absolutely.
when we're looking here at what is in columns A, B, and C, what is your traditional or what is Equitable's traditional COIL product, which is sold to large corporate entities to fund deferred compensation arrangements and so on. What I heard you say earlier was most insurance companies do not offer that product to the individual owned market. Okay, so let's start with that premise, right? So what we've got two things going on here. Number one is that we are offering a product that is not generally available, or probably not ever really available, to individuals who would want to buy this and pay for it, as you said, settle it themselves, own it in a trust, own it personally, etc. Maybe own it in their own business, but in a much smaller environment than the normal large corporate entity purchasing COLI. When you move over to columns D, E, and F, what you are doing is you are stripping out the bulk of the retail comp, to really only allowing a smaller amount to a point of sale or somebody who's going to facilitate and assist in this process. But in effect, the RIA, who is a fee-only RIA, is going to charge the client based on their normal charging practice, right? So it's a percentage of cash values, and it's an enhanced amount over time, and will continue to be, we're going to get into the admin in your platform for reporting and so on in a minute, but fundamentally, I just want to kind of break this thing apart so people are real clear that, COLI products like COIL at Equitable are not available to individuals, number one. Number two is that we're further enhancing the value of that product to allow the advisor to sell it in a friction-free environment relative to compensation, and then allow them to report, aggregate, and put up their forward invoicing and whatever practice they have on billing their client for that. So I just wanted to kind of unpack that a little bit. If I said anything that wasn't 100% accurate, could you please correct me there?
No, first, your first statement, I just want to expand a little bit of the individual ownership. I was on a call earlier today, and the advisor was discussing that each time that he has gotten each time that he wanted to actually market a COLI product to an individual, had to go seek special dispensation, and it was a real hamper in the practice, right, rather than it being traditional. So to that, you're spot on. The second is, yes, the way that the comp works in most COLI cases, even though that Equitable and many of others have brought the comp together, generally half of whatever was priced as compensation was actual sales comp. The other was the implementation and service comp. And that is the part that we retain to meet for the RIA the regulatory environment for implementation, subject matter expert, and being there along with CS administration to support that case for that RIA and the advisor, rather than to leave the RIA naked, if you will, or bare.
Right.
So
Very,
very good comments.
Okay, so now I've got a couple of questions coming in. So let's kind of try to unpack some of these, and they're coming a little bit in fast and furious. So if I'm not an RIA, can I offer this at a fee?
Well, most of us, we can't do both, right? We can't earn compensation, and we can't we can't earn comp and charge a fee. That's natural. these comps do require, allow for a maximum blend. It
Mhm.
is not a fee-based product, but they can zero out their comp to improve performance,
Yep.
to where, Agency One can help them answer that, and then they can make that arrangement with their client because they have themselves not received a dime of compensation.
Okay, so that's a great point, and I want to begin to unpack this a little bit as well, because there are people that are fee-based, which receive commissions and charge fees, and there are others that are fee-only. So in a fee-only environment, the advisor would presumably strip out all of their compensation and charge a client a fee under whatever fee arrangement they have, right?
Yes.
Any commissions that are paid that would be left in the product are really at the wholesale or point of sale level to assist
Correct.
in the sale. Now, if you've got an advisor who is a fee-based, who does accept commissions, then the way to bring that compensation back is through the non-blending, which would kind of put you right back in the columns A, B, and C. Is that correct?
Exactly.
Okay.
Yes.
So there's a couple related questions, and I know Isaac and Carrie, you guys are asking, Carrie's asking, is there an RIA comp built into the columns under the RIA Advantage? That we'll get to that one in a second. But again, just to clarify this, and Freddie, I don't know if you need to jump in here, but COIL, as we know it institutionally today, will be offered under this program with comp if a person chooses to receive a commission.
That's correct.
Fair? Okay.
Yes.
For the fee-only advisor who does not receive commissions, then you use the RIA Advantage to then blend out some of that comp, blend out all of their comp, leave the comp in for point of sale or wholesale, and then charge their client a fee. Am I clear on that?
Yes.
Okay. Now, the next question is there any RIA comp built into the columns under the RIA Advantage? So Randy, columns D, E, and F, where you see the enhancement of 318 over 317 in column B, the delta is whatever, $1,042. So what I believe the answer to Carrie's question, and correct me if I'm wrong, is that the RIA, let's assume the RIA charges 1%, right? So 1% of 300,000 is $3,000. That would be billed directly to the client. So if I'm charging my client $3,000 to manage their money, 1% to manage their money, I would send them a bill for $3,000. I did not accept a commission under that arrangement. Okay. So Carrie, if you have follow-up questions, just text them in, and I will be, I'll be banging these questions pretty quickly. Carrie followed up. What is the approximate drag on return in basis points for COIL? Can you express that? The comp drag on expenses for COIL.
Sure. When you look at the overall goal of comp in the RIA Advantage, the way that it's managed to 7702, you can expect it to be under 1%. The way that it's built. And further, I would like to say that everybody's always tried to find a way to pay an RIA out of an asset, and in qualified plans, it's relatively easy to do. In the non-qualified space, because you're counting on the compounding growth, it seems to be counterintuitive to have the asset actually pay a fee versus just having it flow as commission, because you really want the compounding to be gaining over time. Many RIAs charge a flat rate fee on what they would call outside asset or non-correlated asset to manage whether it's X or Y dollars, and some charge a flat rate or a declining percentage of asset, whether it's 1% dropping to 75, dropping to 50. So,
right.
That is why we enjoy where the institutional product is, and we leave that to the RIA to have it integrate into their practice as it is, rather than standalone cycling. So
got it. Thank you, Randy. There's one. I'm just going to stay on this for one more minute and allow you to continue through your slides, because I want to get to the rest of the material, because it's completely additive to everything we're saying. So there's a question that says, must the RIA be licensed for variable life? What blending is being referred to? So I believe that typically an RIA who is a fee-only RIA is not a FINRA licensed registered rep. This is still a variable product, so it still needs a broker dealer and it still needs a registered rep. So if you are a fee-only RIA operating under the SEC only, then there has to be a registered rep in this arrangement. In that case, if you are a fee-only RIA, in that case, then Agency One's broker dealer has arranged to act as the broker dealer, and Agency One would be the registered rep at a wholesale level. Okay, the non-variable or non-FINRA RIA would then charge their client a fee. If you are a fee-based RIA and you do receive commissions, then clearly you have to be variable licensed, and you have to go through all the compliance process for, you know, being appointed with a company and the broker dealer and the selling agreements and all the other things that need to happen in order to sell this product. So we can talk, Bob, we can talk about that offline, and we can certainly work on getting appointments and stuff in place. But, you know, there's lots of different scenarios here, whether you're talking about a fee-based or a fee-only RIA. So that's why I'm trying to unpack some of this stuff so everybody knows exactly where they stand. The other question was what blending is being referred to. Randy, you want to handle that one?
Sure. What blending is that you're able to, as in any institutional life play at large corporate or bank-owned insurance, you're able to blend the compensation, what would have traditionally been paid out, back into the product for longer-term performance.
Yep.
It's just that simple.
Okay, and in effect, it's, you know, we call it term blend or a blend, but it's fundamentally, I mean, for anybody who's on this call is probably familiar with, you know, Pacific Life or in the old days, Security Life of Denver, or any of these other companies that had COLI products, or even some of them retail, where you're in effect blending out compensation. So it's a form of compensation reduction. Okay, Randy, why don't you keep going?
Sure. You know, we've talked a lot about the traditional institutional life product, which I think by most measures, if people are looking at this, are this certainly solves the cash to cash surrender value issue and gets rid of the, I call it the unspoken objective or the gorilla in the room as to utilizing it as an asset, which comes back to one of your questions and answers of what is the frictional drag or the minimal cost of loads, fees, and insurance versus loads, fees, and tax. And this is why it plays well. But we haven't even talked yet about the RA's alpha. So many of the advisors thought that, you know, it wasn't, we heard everywhere from 0.5% to 2.5% alpha because of if they had the ability to aggregate asset and be able to allocate, reallocate, et cetera, of an asset. So you can just see what a 1% impact to the alpha does with the numbers. And we would rather look at the conservative route, but you can see what the ability does in the ability to grow a plan and make a difference over time, which we felt was important. And again, the product, we talk about product, but we're moving the entire industry with the things that are occurring in the economic environment today is really moving away from client or a product-centric product distribution to those of means, higher income wage earners. What does the platform look like? What allows this to happen? How can I, if I'm in this space, play? What are the advantages to me? Well, you know, as we move forward, the next slide, we talk about features of the RIA Advantage platform. First, I believe we illustrated the product performance, thus increasing the liquidity and access under 7702. The assets under management reporting on the daily account values, we're going to actually show some screenshots of the service platform that will be at the RA's fingertips to address not only the information they need, but access to the investment allocations as well as the billing practice, to the multiple sub-accounts that are involved with these tools, RIA has discretion, given that the advisor or the client gives them discretion for allocation, reallocation, rebalancing. And the design team that we're here to actually assist with Agency One to address the specific client need that's tailored solution for their implementation, whatever that may be. Ongoing is the field support. Agency One's very critical in this recipe, if you will, for implementing the product and the contract administration that we do alongside of the required access to life products for the benefit of the client, the custom design, and the fact that Agency One will be a certified firm. We also don't need the accredited investor documents or the certifications of private placement. While private placement has certainly been out there for a long time, we all know that private placement is just that. It can be a bit cumbersome, and it can also be, there can be some loss of control of the fee structures at times because of I should say, the independent block that it is in pricing. And in our world, we believe that the target for this is the $3 to $30 million net worth range. Because once you get above 50, you have so many different accesses to different ways to do things. And we're really trying to build the zero tax bucket for longer term income management, where as long as you have that zero tax bucket for distribution, it becomes very strong within a holistic portfolio of someone to add this. Certainly, it's not a silver bullet, but it certainly should grab enough attention for 10 to 20% of asset if you're going to successfully get through financial freedom. So what does this? Yes.
Randy, can I jump in there just again, kind of, and I almost hate to say this, I almost hate to use this term, but you mentioned very appropriately that once you get to 30, 40, 50, 60 million and above, the clients really have a lot of options, and maybe private placement is the right place to go there. But when you have that middle market, high net worth, or not middle market, but high net worth market, just not uber high net worth. I mean, this really gives an awful lot of options. And I called it, affectionately PPVUL light the other day, and I almost got scolded. So that's the term that I wanted to use. But I think in a lot of ways, if you look at it that way, it provides a different kind of client for similar product construction that a PPVUL would, right? I mean, is that a fair?
Exactly.
Okay.
That's a fair assessment.
Got it.
Fair
Okay.
assessment. We heard from an RA from the other day that this is really, and it was funny how they said it. They said the common persons, and they said, well, I didn't really mean the common person, but the person that's pretty well-to-do, higher income wager. This is their PPVUL.
Yeah.
This, that type of play, because we're not trying to seek out a particular hedge fund or integrate it with a huge amount of asset and go to that expense, by the way.
Yeah, so, and we're going to get to sub accounts and stuff as well. I've got a couple of quick questions, Randy, and again, I'm sorry to keep holding you up. I have to ask once again, assume the RIA is being paid from another source and not taken from the cash value, correct? That is correct.
Yes.
Secondly, is the COLI's product also free from accredited investor and certification for PPVUL? The answer is yes. Can this be offered to fee-based advisors in the wires? Okay, so wirehouses, let's talk about that. Are there fee-based advisors within the wires? Think Raymond James, think Wells Fargo, think UBS, et cetera. Is this product available in that space?
Yeah, I can jump in there, Randy.
Okay.
Yeah, the answer to that ultimately, Gonzalo, is
well, at this
can you hear me?
Fred, you can answer that.
Yeah.
Yeah, I didn't know if you could hear me. Sorry, Randy.
Yep.
I would tell you the answer to that ultimately, I guess, is yes. However, understand that at the beginning of this conversation, to be clear, we're offering this approach to limited distribution partners for now, Agency One being one of them. So this is not a broad-based offering we have into the marketplace. And so if those opportunities exist in those places, the answer is If they're a fee-based only RIA, the answer is yes, we have an offering, but it's going to have to come through, say, an agency one and the opportunity that Gonzalo and Kathy and the team develop over there, I guess is the point. So we are not going to the wirehouses and offering this in a broad array or offering.
Okay. Thank you, Freddie. Bob, I know you asked that question. We can talk offline. Thank you. I'm sorry, Randy, keep going. Randy,
There, Randy?
I think you may have frozen. Randy, let's give him a second to maybe unfreeze. Yeah, I think he dropped off. Freddie, while he dials back in here,
Yep.
let's talk about the issue of distribution for just
Yeah.
a second. So, and hopefully, Randy will get back on the line here quickly.
Yep.
We have, we talked about the wires, for example. So what you're saying is, and for the benefit of the people that are on the phone who might be working with somebody at one of the institutional wires, if they are doing work within a wirehouse or in conjunction with an investment bank, that we would need to have some sort of a selling agreement and source some sort of relationship with that bank and get it approved within the wirehouse in order to do this work.
That's correct.
Got it. Okay.
Yes.
That's correct. And
All
I
right.
would say, Gonzalo, to that point, and Randy would reiterate this as well, as he and I have had long conversations about other manufacturers who have attempted to go into this market and frankly, some of the challenges that they have faced. And so in learning through that, we've discovered that it's really in partnership at the fee-only RIA opportunity. Again, hybrid is a different discussion, a little bit of an easier discussion, but fee-based only RIA is where partners like an agency one are critical to making this effort actually work.
Yep. Got it. Okay. It looks like we have not gotten Randy back. And folks,
Yeah,
he's here.
There he is.
I'm
Good,
back.
good.
Yeah.
Good. Thank you, Randy. I was afraid we may have lost you there a little more permanently. These are the challenges of this platform, and it just happens in this day and age anymore. So Randy, we just talked a little bit about distribution. I know you've got a number of slides, and I know the aggregation and the platform for aggregation reporting is critically important, and I certainly want to get to that. So why don't you keep going there?
Sure. As we talked about earlier, we talked about the product, then we talked about some of the processes, but let's talk about the differentiator, which is the administration technology support. It provides the RIA with direct access to all the contract and policy data, including AUM, daily values. It provides a historical transaction file that is historic to the policy specific itself, including the original illustration as sold. It provides the asset allocation and reallocation capabilities with the discretion of the RIA. And the annual performance reviews are to establish the return benchmarks based on what the goals are completed with no administration or reporting costs to the client. It's inclusive. It's just important to understand that this is to put the RIA into the driver's seat, if you will, very similar to any of the institutional space that you would be in, and not have to deal with a joined at the hip administrative portfolio that's tied into a carrier legacy system. It's so critical because the first look you'll see here is really phase one. So let's take a look at just some of the screenshots so that people can, if you will, become familiar with that. It's a simple log on. The RIA has their own site. A valuation comes up. You can see over in the left-hand side of the column the multiple areas that you can search of account balance to rebalance and future allocation, what the investment options are, being able to take a look at the updated mutual fund fact sheets, any of the documents that are needed for any potential change in overall management of the contract itself. Statements, we not only provide the statements online, but we also send them out quarterly, just like we would a larger corporate, so in paper. And of course, the RAA or the advisor contact, where the the managing the profile can continue, and of course, then go back. It also then splits or pie shapes the sub accounts so that the RAA can take a quick look at how they're allocated accordingly, especially if they're in the midst of a review and making changes holistically in the overall portfolio, rather than having this just sit on the shelf in another room, if you will. If in fact there is to be rebalance, this is a flawless way to do it, is that whatever the current is, the new has to add up to 100, and it'll list, of course, all the various accounts and what occurs in that space to make it, be able to be forwarded on. If we want to look at the various funds and look at how they may fit within certain sectors or certain benchmarks shift around. We just simply search the funds that are available within the investment options. It brings up the fund fact sheet, the sheets of holdings, et cetera, that I'm sure everyone's familiar with. And of course, then they can do a deeper dive. In the documents would be anything about the plan itself, any of the premiums that were applied, any of the timing that's involved, any authorization forms. In essence, it's a mini unit with a chat box to the CES administrator. So if there's any support that's needed, many it can be handled in technology. If not, of course, that's why we believe wholeheartedly in the power and strength of Agency One, supporting the platform at the wholesale level. They don't go away. That's the best part. And then as we go, just to basic statements that you might see in a deferred comp or a 401k statement that talks about the funding, if there's been any 1035s, any capacity of funding, because as you know, these plans are built tied to 7702. We would not have $1 more of insurance than is required to meet the 7702 access tax codes of the non-MEC or non-modified endowment contract space. And we're always letting people know that this is how we track. They'll be able to see on the site what capacity is left as it relates to overall, again, holistic planning and allocation. Simply put, it brings back the simplicity of cash to cash value with tax diversification. And then the hedges that are natural based on where you live of creditor protection, and God forbid you die, is currently getting a guaranteed step up in basis as it relates to income tax. The process steps for
Randy,
Yes.
I'm sorry. Can I interrupt you there again?
Absolutely.
And if Stacy, can you go back one slide for me, please? The conversation, this whole admin platform that you just shared with us. I mean, that is a client portal, but it's also an RIA portal. Is that correct? Okay,
correct.
So clients can go in just like I can go in and look at my 401k account or my Schwab account or my Vanguard account or my Fidelity account. You can go in, and I have accounts in all of them, by the way. I'm just kidding. But you can go in and look at your stuff as a client, and then take that to the next level at the RIA, because I know that you've got some bridges built to some aggregation platforms, which are important. So I just want to make sure that we can kind of bridge that gap, because the value for the client is clear, but the value for the RIA is not as clear, at least in my mind right now, as you described that.
Sure. Well, let's first talk about the one thing that everybody suffers from, and that's the poverty of time. It doesn't matter whether it's the end user client or it's the RIA. we built this platform so that the RIA and the client can be looking at the very same screens, even though they have, both of them have their own logins, because now you don't have to worry about that and changing passwords. You have your own for being able to have a discussion about this asset among other assets, and being able to share the screens because you're looking at the same screens. One portal is for actual policy owner clients. The other is for the RIA. Second of all, yes, we have already started the work of bringing and moving these assets, integrating with various aggregators. We are already completed with Broadridge and eMoney, and some of the multiple eMoney versions that are used in a number of the RIA spaces. We do know there's other aggregators. However, we built our technology to be able to add aggregators with those firms as needed. We build it so that it is the intelligence. It's more of a plug and play, so that as we move forward into this space, we will be adding aggregators as necessary. We do know that it's been well received because it does roll the values up daily into the assets. So
And that's just so critical for anybody who's doing wealth management and money management and reporting, because the fact that they're just automatically being fed into whatever platform they're using. Now there's two right now. I know you guys are good. This is the launch, right? So you guys are continuing to grow in this space. So you'll be adding more aggregators and more service platforms so the RIAs can really do their job in terms of managing that portfolio as part of their overall portfolio that they're managing for the client within whatever platform they're using, which I think is awesome.
sure, and we have the transparency now that that traditional insurance or even the institutional, that because you have printable daily values, at the very least you can print out and show what the account values are at any time for billable, and you can reconcile to the client what your fee structure is. Obviously, going forward, the integration into the current aggregators just makes it that much easier. But it doesn't go with somebody having to call agency one that has to call Equitable or company XYZ to get me a value as of this date. It's available the next morning.
That's great.
On overnight direct feeds into the CES administration system. So yeah,
Great.
it really helps.
Thank you for that, Randy.
Sure. So how do you really, what's the process steps for agency one? How do you get started in this? Gonzalo, many people want to know really how you can even get going. Well, one of the reasons why of the select few people we're working with is agency one, Gonzalo, Kathy, and their team, is that we are going to partner very closely. We're going to get this right the first time. We have already been testing in the marketplace. We've already found whatever some of the landmines are. And so we know who we want to partner with. And that is where you end up getting two firms without writing a check or having to invest into somebody that will handle and approach the case design. Call Gonzalo, call Kathy, call their team. You'll get a case to sign. They'll discuss the process. We do have underwriting. We call it the COIL Max here, where it's an accept reject. So as an RIA who has explained to their client, and we have addressed with Agency One partnership, the point of sale regulatory requirement for implementation, we also are attempting to make it as easy as possible for the clients. And that is an accept reject up to a $2 million face amount, which is really right at about $100,000 on a 50-year-old. Anything north of that, while we have some room to make a determination, the reality is Now we're getting into risk, and at the end of the day, it is an insurance contract. But from a transactional standpoint, it's pretty safe to say that at $100,000, we can make this happen in a streamlined fashion.
Randy, I'm sorry again to interrupt you. So accept, reject. I mean, what I hear you saying and what I understand the way this product is designed relative to 7702. So, you know, I'm 50 years old. I want to put $100,000 a year in for 7 years. I could be a preferred best, or I could be standard, right? And the fact that I may be standard does not necessarily impact the performance of the contract, because it ends up buying less insurance than if I was preferred. Is that a fair assessment? So
Yeah,
you still have the economics within the contract, and so underwriting becomes less of an issue. You know, that oh, I have to have preferred best thing it's not as critical to the success of the accumulation goals of the client, the retirement goals of the client. Is that a fair statement?
That's an extremely fair statement. In fact, in most COLI spaces, that's why you see multi-life cases go GI versus go in individual underwriting on a smaller group. It's because first of all, the federal corridor reads health, if you will. The second is that most institutional products are priced on a per thousand basis, so that you can understand that if both you're standard and I'm preferred best, our liquidity is going to be approximately the same number, because the difference is I'm going to have at preferred best, you're going to have more insurance than you're going to have at standard, but it's not going to, as you say, eat away to the future or to the objectives of the contract, which is building the accumulation bucket. It's going to read corridor accordingly. So, you know, while it may slightly impact future distribution, it's ever so slightly. You know, we're into 5 bips. I mean, it's not a deal stopper. And, you know, what Equitable has tried to do is be able to say, well, we're starting to shift from, you know, we're trying to culturally shift, and we're not there yet, but we're trying to culturally shift to that client-centric market of what is it that you want to put away, targeting an accumulation total as a % of overall asset versus talking about a bunch of death benefit with sidecars of cash, because that is what the institutional market is all about.
Yeah.
And
yep. There's another question here, Randy. Is 2 million cumulative premium max for RIA? The answer is 2 million max funded is a $2 million of death benefit, Bob. So at age 50, that equals about $100,000 of 7-pay premium. So $100,000 a year for 7 years. At age 50, we'll buy about $2 million. So once you get quite a bit under age 50, if you're putting in $100,000, it begins to buy more than $2 million. So that's where underwriting is going to kick in. This is going to open up the door to an awful lot of cases with very streamlined accept reject underwriting.
yes, and
it gets back to your point of trying to make life easy.
right, and the accept reject is at preferred. So it's not like it's standard or a GI table rate kind of playoff there. It's at preferred, and then we do have some leeway to discuss to get 100,000 in, and we're working right now on something for the spring, as I mentioned. You know, earlier, Gonzalo, you and I, in the discussion about the risk management side of insurance with the current pandemic issues that we have. But, you know, ultimately we want to get to the point where we have, you know, where we have buy-up capabilities with no more than APSs, and maybe at worst a swab, you know, to build or fund a bucket, if you will. I saw we had a question, so I thought I didn't know if you had already answered that, Gonzalo.
I've tried to answer some of the questions just on the chat box, so that if they were kind of one-word responses, I'm just confirming. Okay. So yeah.
So the application process, it's you know, it can be traditional or it can be electronic. If you have access to DocuSign, we virtually can make it touchless. Obviously, in the COLI space, we haven't gotten a lot to the EAP, but that will be coming here. In fact, it's being worked on right now by our team along with Equitable to make it touchless. But DocuSign will give you that same capabilities now. It's just, you know how it is. You got to fill it out, and but it can be done without an in-person sit. So our team is very good at working with that, and I'm sure you got your team at Agency One will as well. So in summary, it is giving access. What you can bring as an RA or as an advisor working with RAs with Agency One, you can bring the institutional product space that we talked about. You can leverage the integrated third-party administrator with technology, the management to IRC 7702, and advisor investment discretion. We have the support system built to meet the regulatory requirement of implementation, and more importantly, ongoing support to the IRA in efforts for their client with an answer rather than an 800 number. And we have the technology drive in the service portal that we're creating those opportunities to be able to continue to expand as we move deeper, both in depth and breadth in this market space. And we have, many of the RAs have had expressed concerns about a non-disclosure, non-solicitation, non-compete as they're adding 7702 assets back into their overall purview and oversight. And this is something that we include in the package as well. So that is executed by the specialty advisor with the RAA. So at this point, Gonzalo, I'll open up questions, but here are the contact groups that for Agency One. And I don't want to speak, I know I speak for Fred, but I'm truly excited because I will tell you Agency One has spent months, literally months with CES and Equitable in procuring the point you're at, and hats off to you guys for being patient while we were, as I said, getting this right and getting it right the first time through some of the testing we've done. So
thank you for that, Randy. Thank you. I do have and nothing ever happens quickly at any insurance company in order to get things right, and that's not picking at anybody in particular. I think, Randy, you were the one that really said, if we're going to do this, we need to make sure that we've got everything buttoned up. There's a couple of questions, but before I get to that, I want to ask you one other question. There have been some dialogue around, so AXA has a pretty broad fund platform, Equitable, sorry, I got the nod from Fred as something that Equitable has a pretty broad fund platform. You have spoken of additional funds or a different set of funds. Kind of where is that going? What's going on in that space?
Yeah, thank you for asking that question. Yes, we have a broad base of 80 plus funds, and the uniqueness of having the guaranteed interest account with no toll gates, if you will, back and forth, at least at this point. And we haven't, since I've been with Equitable working as a consultant or actually being purchased, so 12 years. As well as we have a cap and a collar or an index sleeve that's only 115 basis points to get to the put and call tied to the S&P 1 year point to point. Obviously, as a defensive measure for many people that are acquiring this, but yet it certainly is a tool that can help build that portfolio out. But to further discuss that, the institutional product space is a 9-inch pie. It's not 8.5, it's not 9 1/4, it's 9 inches. And when you look at where you want to be of strength, while we have a very solid funds lineup, we're shoring up some of the various sectors now. We've already had 2 meetings, and when we have to make those decisions is at the end of November, early December for perspectives time and offerings. But I will say that what we're trying to do, especially in the RIA space, where the real benefit is the improved performance based on reductions in pricing, and then the alpha. So as long as we have funds that we have caps, for example, now, even if the fund's at 97 bips, we cap it at 80. If it's got 70 bips, we cap it at 50. And we're doing things already like that to improve the performance of institutional product. But going forward, while we will be adding various, I call them index funds, we also want to make sure we're protecting the statutory pricing underneath, which has been the Achilles heel for a lot of private placement VUL products, where all of a sudden they had runaway costs of insurance or administrative fees because the big shifts to 4% index funds, if you will. So what we're doing is we're trying to round out those buckets with a lot of input from RIAs of quality and performance-based funds that rank, if you would use your RPEG or Morningstar and FI 360, you would put those blended together that is a fiduciary look, and making sure we have the additions of those funds to be hedge fund-like and or high-performing funds with the natural caps the product already has, to take advantage of the market without putting pricing in jeopardy and weakening it out there, which you've probably seen, and so have I, occurrences like that in years 8, 9, 10, 11, which are really critical years for the longer term accumulation. So hope that answered that.
It does, and thank you for that. So we'll know more come prospectus time next year, maybe sooner, is what I'm hearing.
Yes, we'll know the lineup by soon after the first of the year.
Got it. Okay, I have a question here from somebody from Ham Pointer. It's a long question. It's got several questions, so let's unpack it here for a second. In summary, this is a brokerage VUL product that is available for RIAs and duly registered advisors to strip out or blend the retail commission out to mimic a fee-only product, and let the MGA, in this case Agency One, act as the official broker of record. That was a question. I think that, I mean, if you net it out, I believe the answer is yes to that.
I think it's yes.
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 Then the follow-up. So the RIA or duly registered advisor can charge fees back to the client for brokering the product via the MGA, period. I think that's right. Who fills out the best interest contract and application? Okay. So my understanding, Fred and Randy, is that Agency One, through the Leaders Group, is acting as the registered rep if it is a fee-only advisor, or if it's a duly registered who has chosen not to take a commission. If the duly registered has chosen to take a commission, then they will act as the registered rep. Otherwise, Agency One will. Agency One will then need to deal with our broker-dealer to make sure that the suitability and all the paperwork and everything is appropriate to make that happen. And for that, we're getting paid. Okay.
Correct.
Who is liable for knowing the client? That's part of the KYC that we're required to have with our broker-dealer. Who fills out the best interest contract? Presumably that would be Agency One as well, through the paperwork that we need to fill out with our broker-dealer.
Correct.
I answered all those.
That would be the implementer, yes.
Got it. Okay. Then are there index options with the sub accounts? The answer is there's one index, and I believe, Randy, you mentioned it a little bit. So we've got a bunch of variable accounts. We've got a fixed account, and we've got one index account.
Yes.
Right? Okay. Got it. Can you describe, is that the MSO? Is that the market stabilization option?
Yes,
okay.
That is the MSO, 1 year point to point. As I said, the underlying cost is very competitive at 115 bips
Yep.
for the put and call in the marketplace. So,
okay.
yes.
And then from Chris, we have, are there any other associated costs charged by the insurance carrier aside from costs of insurance? The answer is yes. Administrative costs, yes. Is this product available for distribution? The answer is yes. Ready to be illustrated? The answer is yes. Chris, I will call you and we will talk about the case and client you're specifically thinking about. But one of the reports that I love about this product, well, it's coming out more and more in most illustration software products platforms, is that we can print a page with every single expense. There is absolute full transparency in the way this product, and frankly, more and more products are being illustrated. So I'll talk to you about that offline.
Yeah, Gonzalo, we always include that. Ours is always included where, as you know, many of the
It's
carriers in
optional.
the marketplace, you have to especially request that.
Exactly, exactly. I think we are past the hour of 4 o'clock. I can't believe we blew through an hour on this, Randy, and I'm so grateful for you spending time with us on this. Kathy, first of all, Randy and Freddie, thank you for doing this for us. We're super excited about this opportunity, and we're honored to be one of the few select agencies around the country in this launch, and we look forward to working with you guys more and more on this. So Kathy, back to you.
Thank you, Gonzalo. And thank you, Randy and Fred and Equitable for sponsoring this session. A few quick reminders. Please remember to fill out your surveys. They will be emailed to you later this afternoon. Also, we hope that you will join us tomorrow for a very special Wednesday. At 11 o'clock Eastern Time, for the final time, our virtual exhibit hall opens for 1 hour. Please be sure to visit with our sponsors and carrier partners. They have a lot of really great information to share, and this is your chance to talk with them about any year-end concerns or opportunities you may have. And also, please remember that Agency One has a booth in our virtual exhibit hall, which is manned by our phenomenal underwriting team. I hope you will visit with them as well. Then, at 12 o'clock noon, we have the finalists for our idea sharing contest. You will have the opportunity to listen to your peers present sales opportunities that are working for them, and hopefully an idea or two will also resonate with you, and you will be able to incorporate these ideas into your practice. And finally, our last and final session on Thursday features the CEO of an estate financial planning and wealth advisory firm who has worked with some of the nation's most successful families. He will be discussing new planning opportunities available in this changing economic, political, and legislative landscape. We hope you will join us for all of the remaining sessions. Again, thank you for your participation. We hope to see you tomorrow, and please reach out to Agency One if we can be of any assistance. This concludes the session for this afternoon. Thank you again.
Thank you, everybody. Appreciate it. Bye-bye.